I see this all around me, and I used to be exactly like this. A trader that's desperate for profits. Now, because you're so desperate, you start staring at the chart without actually knowing what you're looking for. And that's the problem, because then your mind starts hallucinating these trade ideas that aren't really there. The same as a dehydrated person walking in a desert, hallucinating and starts thinking that there's water. Your mind is just playing tricks on you. Now, like we mentioned, you start staring at the chart because you don't exactly know what you're looking for. So to fix this, there's really only one thing we need to do. We need to objectively know where we look to get involved, where we look to buy, where we look to sell. If you can't objectively and accurately say that, then there's work to do. And it's perfect timing because this video will exactly go over that. By the end of this video, you will know exactly where to look to get involved. So which level you want to buy, which level you want to sell. Now there's 3 things to it. First of all, we need to understand a clear target. Then second of all, we need to understand how we set parameters. Then third, and arguably most important, is knowing which opportunity to profit from. Today, we are looking at NQ or Nasdaq from CME right there, or in other words, for some people, US 100. Now, I need you to understand what we're going to talk about works on every market. We're using Nasdaq today because this example we exactly broke down on Tuesday in the live session in the MMT. And it's also a move, as you can see, that I profited from right here with a winning trade. Now, don't get me wrong. I'm not telling you that to help with my ego. I'm telling you that because what we're going to talk about is objective. So if you understand the objective rules, you can apply them and you can profit from it. That's it. Now, I don't want to make it seem like it's easy because I don't think it is, but it is quite simple once you understand it. And the first thing to lead to that understanding is, again, understanding that clear target. A clear target, in my opinion, is quite subjective. For example, for someone, this low right here, that swing low, might be a very clear target, but we might never reach that target. So we need to make it a little bit more objective. Now, the way I like to make it a little bit more objective, but arguably still subjective, is by saying, okay, a target is a clear target when it's stupidly obvious. So you can open a chart and in the first 10 seconds, you can know this is likely the next target. But like I mentioned, I also think that's quite subjective to a certain degree. So we're going to make it more objective. The way we make this more objective is what we're going to talk about in just a second. But first, I need you to understand, you can probably already notice, I'm starting on the higher time frame right here. And the reason why I want to emphasize on that is because I used to be someone, a trader, who was just opening the chart. Okay, skip all the higher time frame. Let's just go into the 5-minute right here. Let's find the first best 5-minute fair value gap that we can find. Try to trade from it right there and then just lose. The lower time frame will absolutely destroy you if you don't understand how to use it. Now, don't get me wrong, I'm not saying, and I'm sure there are people out there that can make the lower time frame method work. So by diving into the chart, immediately going to the lower time frame right there. But I also am convinced that for the average trader, trading becomes a lot easier on the lower time frame when you understand what the higher time frame wants to do. So that's why we first start on the higher time frame. Once we have a higher time frame target, we can then understand what the lower time frame wants to do more accurately, and we won't get tricked by certain fake fair value gaps. So to make this target a little bit more objective, the first thing you want to understand is that the market is always moving towards a higher time frame PD ray. So for example, the PD rays that we see right here is we have this fair value gap that we've already traded back into. And after that, we also have this swing high right there. Now we're looking at a monthly time frame. The monthly time frame can have a clear target, yes, but it's still quite far away. So I like to go down time frames. And on the weekly time frame, what do we see right here? If we use the replay tool, then we see that we have this high right there, and we also have this fair value gap right there. Both PD rays, and the market price is always moving towards a PD ray. It's just our job to find out which one is next. So when we understand the target is a PD ray and we have marked out the closest higher time frame PD rays right here, then it just becomes an understanding. Are we first going to reach this weekly fair value gap, or are we first going to reach this weekly high right there? And the only way we know that is by understanding when it's obvious. If it's obvious that we are going to reach this weekly fair value gap, or if it's obvious that we are going to reach this high. Now, of course, quite simple, right? No, it's not like that. We need to objectively break it down, of course. It's obvious that we're either going to reach the high or the fair value gap right there if there's only one-sided arguments to it. Okay, one-sided arguments. So what does that mean? When you open the chart, usually Traders tend to be more 50-50 than they are one-sided because they can see price moving towards both sides of the market. When that's the case, you have arguments on both sides of the market. So arguments are essentially suggestions in price. So it's suggesting that it might continue lower. It's suggesting that it might continue higher. So a good and great suggestion is, for example, a fair value gap in itself, because a fair value gap, essentially what we see evidently in previous price action, it quite accurately tells a direction. So for example, right here, bullish fair value gaps, bullish fair value gaps, bullish fair value gaps. So they suggest that we might want to continue higher. Next to that, you also have a sweep versus a run on liquidity. So for example, when we run liquidity, like we see with this swing high, for example, right there, the first sting above it is like a wick right there, a long wick. Now, when you have a long wick like that, that usually suggests, okay, we might be sweeping it at that moment in time, so we can expect some lower prices. Then we see right here, we keep continuing higher. So we have a second sting above the swing high. Compare that, this is a run, compare it to a sweep. So a sweep right here has just this long wick right there, and then we continue higher again. So those singular candles, a long wick like we see right here, or just a long body like we see right there, it's also a suggestion in price action. Those suggestions, they are arguments. Now that's going to become a little bit more clear as well as we move on in the video right here. So what most people would assume right here is, okay, we have this fair value gap. So in theory, right? A fair value gap, we should trade back into that to then continue higher right there. Now, that thought process is not necessarily wrong, but you should also understand that there's a big important rule to fair value gaps. Trading towards fair value gaps is always lower probability than trading from fair value gaps. Why? Again, a fair value gap right here is a suggestion that we might continue higher. So it's bullish momentum. So when you're trying to short, so trying to sell back into the fair value gap, what are you essentially doing? You are trying to trade against the overall momentum. So in a bullish market, what is guaranteed? That we are going to continue higher, right? But it's not guaranteed that we are going to see retracements back into fair value gaps to then continue higher from it. Now, what tends to happen is that these retracements, they are easier to spot usually. And the expansions, they happen faster, so they're sort of harder to catch because you literally have less time as well to spot them. But we want to focus on the expansions right there to continue higher. But if we now go into the lower time frame a little bit, so into the 4 hour right here, then we do, for example, see a bearish fair value gap right there that we might want to continue lower from towards the weekly fair value gap right there. And if we skip ahead to the Tuesday where we did a live session in the MMT, then we arrive at this moment right here. So when we open this chart, we have two targets. We either have the weekly fair value gap that we might trade back into, or we have the highs right there. Okay, what are we going to reach first? Well, what we see right here is that we have disrespected previous fair value gaps right there. So we essentially failed to continue higher from it. Now we are potentially sweeping this low right there. Now, I wouldn't necessarily say that we are running this high just yet, because we're also failing to create this bullish fair value gap right there on the 4 hour. So essentially, we can draw a very simple conclusion. It's quite 50-50. And you might say right here, we go into a time frame below, well, Arjo, there's a very clear fair value gap right there. There's a very clear fair value area right here that we can continue higher from. So why does this 50-50 even matter right there? Well, the reason why is, again, it comes back to the basic as a trader, and it sounds very silly what I'm about to say, but we want to essentially win more than we lose. So the best trading opportunities happen when the market only has one-sided arguments, when you can only clearly say, well, I can't see how this can turn bearish. This can only really be bullish. When that happens, that's when we look to get involved, because then the probabilities are so much in our favor, essentially, that it's quite hard not to be profitable. And right here, for example, what we saw, if you only looked at the lower time frame, what we also saw is that this fair value area towards the left gets essentially disrespected. We get these bearish fair value gaps right there. Now imagine how many traders sat there thinking this right there, that's going to be the move of the day. Let me place an order right there. Perfect. Let me short it all the way towards the weekly fair value gap, only to then a couple of minutes later to get taken out at a stop loss. Like, what happened? Well, that's because at that moment in time, we were more 50-50 than we were really leaning towards one side. So we had both bullish and bearish arguments right there. And that leads us to the next thing, what we need to understand, and that's about setting parameters. So how do you actually set parameters? Because parameters are essentially the answer to the question where you look to get involved. How we know that and how we knew that for Nasdaq right here, we're going to go over in just a second. But again, I'm sorry, but I need you to understand the following. I wouldn't be saying it if it wasn't important, but I believe traders, they think too much. They overthink too much. So in all honesty, I've written this down and I just want to read it for you so you can understand it. So I wrote down, as a trader, what do you really care about? As in, at its core, what is your objective? I believe, and the reason why the MMT is called the MMT in the first place is because I believe traders come into trading because they're looking to make a profit. Very plainly said, making money. So if that's the objective for the average trader out there, then why in the world do we think as traders about what is happening in the market, or why is the market moving like this? Why is the market exactly reversing here? What I'm trying to get at is that traders are constantly trying to decode every single market move, like trying to understand the secrets of the market. And the reason why, and I've also been in this cycle, and the reason why is because we think that the answers to those questions will be the secrets that will lead us to winning and making money and 100% win rate. And it's important that I mention 100% win rate, because usually people tend to ask these questions because they always want to know what's happening, because they want 100% win rate, because they're trying to avoid the pain that they will have with even an 80% win rate, because with an 80% win rate, which is insanely good, you're still going to lose. Now, the answers to these questions, they are irrelevant. They don't really matter. First of all, nobody knows the exact answers to these questions. And if they do say they know, then they're just guessing based on the theory that we use. So for example, we have also theories that we use that objectively give us guidelines on what we want to do in the market. That's why we use them. So we're all just stating our own theory on what we think might have happened in the market, or what we think might happen. Now, what I believe, especially in the niche that we are in, I'm sorry to burst your bubble, but I think we have been fooled for a large part into thinking or believing even that we need to know the answers to every single market move that is out there. That's not true. And as I've stated before as well, the market is all about probabilities. So the reason why I wanted to ramble a little bit on that is because I think this will change your mentality as a trader. I think traders nowadays are losing too much sleep over what is happening, why is it happening, what could potentially happen. Listen, all you need is what I'm about to tell you, and that is setting parameters and letting the probabilities play out. That's it. If you do that consistently, it's very hard, again, not to be profitable. So what are these parameters that I'm talking about? These parameters are essentially the moment, the sign that it's almost confirmed that we are going to reach the target. So for example, by the time we might be trading right here at that level, it's arguably confirmed that we are going to reach the weekly value gap. Why? Because we are so close to it. Now that could be a sign. Now we can make it a little bit more objective with the concepts that we're using. So this is, for example, still why we use these theories, because they give us guidelines and understanding of what the probabilities actually are. We're just working to find what the highest probability is. And if we consistently do that, again, it's hard not to be profitable. Based on our concepts, the biggest parameter that you are going to have is when, for example, if we are running highs or if we are running lows. So if you mark out that high and we mark out this low right there, if we either run this high right there, that will tell us, well, it's very likely that we are going to reach this next star right there, because there's no bearish arguments or anything like that, only bullish. The same, by the time if we run this low, it's also very likely that we will trade back into this weekly fair value gap right there, because at that moment in time, we might only have bearish arguments. So those signs become your parameters. But I need you to understand, the market will essentially tell you what it wants to do very simply by just following the price action. But just like sometimes people listen to other people telling a story and they're not actually listening, they're just more so thinking about what their reply is going to be. That's the same for the market. The market is telling you a story, but most people interrupt the market and they don't let the market finish that story before they look to get involved. So our parameter, and at that moment in time, what you would want to do, you just place an alert right there above the high, and you would place an alert above the low right there. And either that alert goes off or this alert goes off. So again, see how it's not, you don't even need to predict the market to a certain degree, right? You just need to understand, if X happens right here, I do Y by looking for an entry. If Y happens right here, I do X by looking for an entry to go short. So at that moment in time, this alert right here went off. We now reached above the high right there. Now, the first time we reach above the high, again, this is the first sign that we might want to continue higher. Again, we need to eliminate all the bearish arguments, all the bearish suggestions that we might want to continue lower. So for example, from a swing high, what can we do? There's only two things that we can do from any swing point. We can either sweep it or we can run it. So this swing high could still be swept right here to continue lower instead. We're essentially just assessing all the different options of what can happen. And when we then only come to the conclusion, well, we really only have one option of what can happen, that's when the target becomes clear. So right here, we could potentially still be sweeping this. And that leads to us needing to understand, okay, well, what is then a difference between a sweep right here and a run? So again, a sweep is where we sting above a high, for example, like this, and we aggressively reverse right there. It's usually also seen through wicks. Whereas with a run on liquidity, it's something like this. When we reach above this high, we at first have a reaction. Yeah, that reaction right there is arguably inevitable. It's always going to happen. But what we then do afterwards, that's the most important story. So are we going to then aggressively reverse right there? Or are we going to continue higher? And at that moment in time, you don't need to know this, right? You don't need to know at that moment in time, the first time we reach above a high, if we are going to sweep or run it. It's just a matter of objectively reacting. So right here, the first time we sting above it, right there, we might create a rejection right there to continue lower. But you'll see very soon after, we start to create these new up candles. The way I like to call this is that we are now comfortable above a high. So we had the first sting, then we have a second sting right there. There's no aggressive rejection to continue lower right there. So in other words, there's no need to sweep that liquidity at that moment in time. Now then, everything that we have done so far, that was the hard work, the quote unquote hard work right there, just objectively understanding which side we want to move towards. Because right now, when we are running this high right there, then that target becomes very clear. It becomes this high on the top. Again, why? Because now we only have one-sided arguments. We only have bullish arguments in place. There's, at this moment in time, no suggestion from price action that we might want to continue lower instead. When we reach that moment where we only have one-sided arguments right there, then that is the moment where you look for an entry. Now, this entry it's again why I mention the hard work was just done on the higher time frame and those arguments. Because the lower time frame, your entry is it's quite easy. It's just to do whatever you want. Now, of course, it's a little bit more nuanced than that, than just doing whatever you want. But when you look for an entry, for example, right here, because that was my entry, then all you're doing is just determining, well, how far can we actually now retrace? This is, again, also where the PD rays come in. So if we are going to create a reaction that we are going to potentially continue higher from, it's going to be at PD rays. So for example, usually what's going to be the case on how far we can retrace is that you'll have a fair value area in your order flow leg. This is the fair value area right here in your order flow leg. And you also have a fair value gap right here. This is, in other words, what we call the fair value area right here is currently the first line of defense, is the first PD rate that price will approach once it does create a retracement. The fair value gap is the second one. So that's the overlapping defense right there. When that's the case, then either the first line of defense or the overlapping defense should hold to continue higher. Now, and I mentioned very specifically should hold, because in order for price to remain high probability and in order for price to only keep those bullish arguments, those, either the flood or the overlapping defense, should hold. Because if both fail right there, then what happens is that we now have a bearish argument in place. So in other words, we're not high probability anymore. So your stop loss goes at the area where price moves from high probability to now low probability. In other words, where price has now disrespected, for example, the overlapping defense. So your stop loss can go very well below the overlapping defense right there. So sometimes you see people put their stop loss all the way below that low. Listen, this was, well, you could argue somewhat of a day trade. If I put my stop loss all the way at that low, this from a day trade turns into almost a swing trade. So sometimes your stop loss is actually going to be safer if you refine it a little bit more right there. The reason why is because your take profit is then going to be a little bit closer right there. And if your take profit is closer, you can earlier close this trade as well. So my stop loss was below the overlapping defense right there, targeting a 1 to 2. I always target a 2 RR right there. And then essentially, that's it. I just wait. I sit back, I don't do anything, and I just wait for this to potentially hit my take profit or potentially my stop loss. I couldn't care. Again, you need to understand your job as a trader is done. Once I have found this high probability trade right there, my job as a trader is done. Your job as a trader is to consistently find the highest probability trades. And if you consistently find the highest probability trades, and again, highest probability, what does that mean? When you only have one-sided arguments in the market, when that happens and you consistently execute, then again, over 2 trades, you might not be profitable. You might lose both trades. But if the process of getting to that trade was high probability, then don't worry about it, because then over 100 trade sample size, you will maybe win 50% of all the trades. And if you win 50% at a 1 to 2 RR, you're going to be profitable. And then that right there is the trade I took. Now here on TradingView, it did not hit take profit right there. On MT4, it did. I'll show you the screenshot right here. That leads us to the last thing that we need to understand, which I mentioned in the beginning, arguably the most important. And that is which opportunity to profit from. Just because you can spot an opportunity does not mean you need to try to profit from that opportunity. For example, I see a lot of bearish value gaps right here in the live market on Nasdaq. I have 0% interest to try to profit from a bearish move right here. Now, let me explain why. I need you to understand the following. I have seen people say in the past that they are able to trade every day. So they say every day is a trading day. And although that might be true for some people, I think if you truly believe that every day is a trading day for you, then you don't have enough data on understanding what actually is high probability and what actually is low probability for you. Because I'm absolutely certain that if you actually start to gather that data from live trading and you start looking at it, you'll start noticing patterns between your high probability days and your low probability days. So for example, right here, do you remember how we said that anything that is bullish right here, any buys, that's already our preferred trade ID. Because if we take a look at Nasdaq right here, then we saw that we had this bearish monthly fair value gap. Now we had such an aggressive third candle right there coming into it that on Nasdaq right here, that already was sort of a sign that we want to see, okay, well, this might be reaching new all-time highs right here. When we are disrespecting this monthly fair value gap by now, that sort of arguably somewhat confirms it. Now, of course, nothing confirmed, but the probabilities right there are then really in our favor to reach the all-time high. So when we then have a lot of bullish momentum right here, any shorts trading back into, for example, a fair value gap is automatically already going to be lower probability because you're trading against the overall higher time for momentum. So, for example, if let's say we did see that price was actually running this low instead right there, trading towards the weekly fair value gap right here, then just because there is an opportunity does not mean that you have to risk capital on that opportunity, because it might not be worth it. And this is what you want to really work towards. And you might think, well, I'm not trading 6 or 7 figures, I'm trading a 5K account. If you're trading a 5K account, this is just as important as when you are trading in the future, hopefully trading a 500K account. And the reason why is because if you don't set that foundation very well for your trading, even when you have a very small account, then you're going to build bad habits. And those bad habits are going to build even bigger onto the bigger accounts as well, which makes it then very hard to scale because you need to take out those bad habits, etc. If you watch my YouTube channel and you struggle to put everything together, you struggle to consistently find high probability trades, then check out the MMT because that's exactly what we specialize in. All right, perfect. Thank you.